I'm Jessica Minton for IB Times TV, reporting from the floor of the New York Stock Exchange, and joining me today is Michael Gaillet, the Chief Investment Strategist of Pinch & Partners. Now, it's been an interesting week because of those fears about military strikes in Syria, but we did get some better than expected second reading on the second quarter GDP number. How exactly is the bond market and the stock markets responding to Syria right now?
Well, you know, look, whenever you have any kind of war situation, you tend to have these flight to safety trades, at least in the initial reaction. And it's not really clear if we're actually going to do the strike, given some of these delays that are starting to come out now with the administration. Now, you know, I think everything takes a backseat to this taper. Everything takes a backseat to what could be a dangerous spot for oil prices, which Syria obviously does have an effect on. But to be very clear, as much as everyone's focusing on Syria, oil has been outperforming since early June the S&P, meaning it's been outpacing the equity gains we've been seeing, diverging actually quite a bit from other commodities. There seems to be something else happening in the oil market, which in turn could be a very big negative if Syria pushes oil prices into a spike-like moment, as was the case in mid-2008.
Now, you have been pointing out in some previous interviews that there are a lot of parallels between the stock market crash in 1987 and what's going on right now. Can you talk about that?
So, look, this is not hysteria. There are certain things which are facts in economic history. Interest rates are the key to everything in a capitalist society. Prior to the crash of '87, interest rates were spiking. 10-year yields reaching 10%, which is obviously much higher than where we are now. And you had a runaway Dow Jones Industrial Average up until the point it was north of 30+% on a year-to-date basis before the actual crash. Spiking yields were felt with a lag to the Dow, and the massive outperformance of stocks relative to bonds cratered on the crash. That relationship got back to some kind of a historical trend. You have a lot of similarities this year. As this taper talk began, we started seeing yields spike. We started seeing the Dow continue to do this runaway move. Now, does that mean you're going to have a crash like '87? Probably not, but it is something to be very, very cautious about. The fact that yields have risen the way they've risen, despite the Fed still doing what it's doing, indicates they may have lost some control here of the bond market. That has massive implications on every single investment out there.
Now, we are coming up on another fiscal cliff crisis. Do you think that the Fed may not taper in September, that whole September debate that is going on? Do you think they'll hold off because of the fiscal cliff crisis?
Yeah, I think the Fed backed itself into a corner to some extent. It's becoming a little bit more clear, given recent housing data, that the yield spike may actually start causing housing, which is the biggest source of growth and reflation for the economy, to actually be a drag on the economy. And if you look at home builder stocks, I've made this point quite a bit, home builder stocks have been awful all year. Those betting on housing don't believe housing is going to be that great going forward. So how can the Fed really taper and step away when everything they're betting on is actually going down, right? So I think what may likely happen here is either they're not going to taper or they're going to taper very, very little. If anything, just to show the market procedurally how they would step away. If they taper $5 billion, that's nothing.
Now, speaking of housing, as interest rates eventually have to start rising again, how is that going to impact the housing recovery that is going on right now?
Well, I mean, it depends on where wages are, obviously, right? I mean, a lot of people say, well, you know, the consumer can handle a mortgage rate of 5%. Maybe, but that assumes that wages are compensating for the extra costs of servicing that mortgage, right? So it's not clear just yet. If the economic recovery is really there, people should be able to afford more. They afford more, they can handle higher interest rates. The evidence is really not clear just yet on that, especially, by the way, going back to oil, how that could impact housing. You know, if oil starts sucking consumer spending, discretionary power out of the equation, and on top of that you have rising mortgage rates, a lot of people who might otherwise say, okay, I want to buy a house, might continue to do what they're doing, which is rent, which we've seen a big trend towards renting lately versus ownership. So I think, you know, it's not as simple as to say, you know, it's the consumer can handle higher rates. What's the context under which the higher rates occur?
When do you think the U.S. stock market is in for a correction?
That's the big question all year. So let's talk about how corrections historically happen. Corrections tend to happen when you have these deflationary scares. And actually, the bulk of this year has been driven actually by falling inflation expectations. Now, the Dow, the S&P, the U.S. market has diverged despite falling inflation expectations, which is historically unusual. But those inflation expectations still are not picking up. And they're not picking up despite the Fed also pulling back on QE. Now, the fact that this yield spike has occurred, if it's not contained, I think you're nearing a point sooner rather than later where you can have what I have been saying would be a doozy of a correction. Why? Because nobody sees it coming, and everybody is thinking that a trend in rates is bullish for the market, ignoring the speed of the trend in rates.
Now, looking ahead towards next week, we are getting the jobs report for August, but there seems to be this disconnect between the U.S. equity market, when we have seen the Dow and the S&P have these rallies this year, versus the actual U.S. economy, the jobs numbers and the GDP numbers. How long exactly can this wealth effect last if we don't see wage growth continue to grow?
I'm pretty sure the Fed might have an open position for somebody looking to answer that. You know, and you bring up an excellent point about this. Look, the Fed is trying to target the wealth effect by increasing the value of homes and stocks. Now, the man on the street really gets more affected by their home value rather than the stock market. As professionals in the business, we're invested, but the vast majority of individuals, they're not really going to feel necessarily what's going on in the S&P and the Dow. That, on a separate note, is what widens the wealth gap between the rich and poor, because those who have stocks and assets end up benefiting the most from what's going on with the Fed. Now, this year, oddly enough, I think there's a couple of explanations for why the Dow diverged so much from everything else. Because when you look at cyclical sectors, they've been underperforming. That's not consistent with growth. You look at home builders, they've been underperforming, not consistent with growth. Commodities, not consistent with growth. Emerging markets, the suppliers of developed markets, not consistent with growth, the way they've been behaving. I think largely what's happened this year is, one, you had massive underinvestment into the first fiscal cliff paranoia. Two, the reality is for the last several years, because of low rates, the supply of U.S. stock has been shrinking, shares outstanding, at probably a faster pace than people pulling out of the stock market. So supply is falling, but demand's falling, but supply is falling faster. And that means that any marginal movement in the stock market causes an accentuated trend. How long that lasts is anybody's guess, but you're at this juncture where at some point fundamentals you somewhat have to kick in. And fundamentals not in terms of what we saw, which was actually okay economic data based on lower rates prior to the spike. Now that we have the spike, it's a big question mark. How is economic data going to react to that?